Ryan Irvine is with me. KeyStone Financial works with us at the World Outlook Conference. Does a fabulous job all year long, by the way. You can find him at keystocks.com. But we, of course, get Ryan to get down to work, roll up the sleeves with his gang, and produce the World Outlook small cap portfolio. We've been doing it for 10 years. Every single year, more than well over double-digit returns. And I'll talk about that in a minute. But Ryan, Michael Levy and I were just chatting about something that relates beautifully to what you're doing. You've got a couple of upcoming webinars, I should say, November 10th and November 17th. I'll give details in a moment, but it's the thing that I'm always concerned with. What can I control? And I want all the listeners to understand you can control the construction of your portfolio. And that relates to something you're going to talk directly about, and Mike was just talking about, and that's look at those FANG stocks, Facebook, Apple, Amazon, Netflix, Alphabet, Microsoft. Come on, buy, sell, or hold. You're going to have a look at that.
Yeah, thanks for having me on again. Happy Halloween to all you and your listeners. For sure. We have our new round of live webinars coming up, building a modern portfolio, 15 to 25 stocks. You guys just talked about the FANG stocks. One of our special topics that we have is we literally go through every FANG stock. So Facebook, Amazon, Apple, Netflix, Alphabet, which is Google, and we include Microsoft in there and tell you whether or not they're a buy, sell, or hold, whether or not they should be added to your portfolio today or in the future. So that's one of our special segments that we have there today, really topical right now with you saw the moves in FANG stocks this week to the upside and the downside.
Well, the other thing you're going to talk about, by the way, and you can give us a little hint right now, is one aspect I've been very interested in. We've been chatting about on Money Talks, and that's telemedicine. Is that going to be one of the big winners coming out of sort of the pandemic lockdown where people are doing a lot more telemedicine than they've ever had before because we're not going to the doctor's office? So you'll be having a look at that one too.
Yeah, we'll look at telemedicine and new healthcare opportunities, where the valuations are in this, like you said, very hot segment. One of the companies we actually recommended at the Outlook portfolio this year has a large part of their business in telehealth. So not only that's why they've been able to do so well this year. That's Enghouse. We might talk about that coming up. But one of the reasons they've been able to do so well is because they're exposed to that segment, and they saw a boom in business during this pandemic and the shutdown that we saw. So telehealth is a big topic that we'll talk about, and also home health care. And we'll talk about a company that's in that segment today as well.
Let me just come back to the broad market, knowing that you were coming on with me this weekend. I'm looking at the market declines this week, and I'm thinking, does that put a smile on your face? Because that just makes the valuations better if you've got confidence in the sort of quality of the business that stock is in. So I just wondered about that. Some people sort of panic when they see the market drop, nearly 1,000 points, midweek, and plus it didn't show any strength coming out of the end of it. And I'll talk to Victor Adair about that coming up. But I'm just asking, does that put a smile on your face? Say, oh, good. That makes this one a little bit more attractive.
Yes. Are we sadists? I'm not sure. But yeah, when we see a company that we really like, that we've been analyzing for years, that we want to participate in, come on sale, it's something that we really like. And we talked about the FANG stocks. Apple was off 6.5% this week. Amazon 5.5%. Netflix 5.5%. Twitter lost 21%. Out of those FANG stocks, only one was actually up. I have to say, I'll toot our horn a little bit. It's a company we actually recently added, Alphabet or Google. It was trading at the best value, we thought, in that group. But yeah, when they come on sale, if you really like the business, that's when we add more. For a brief moment there in the pandemic, you're like, in terms of the stock valuations, you're a kid in a candy store, and we came out with some recommendations in March at that time, and there was great valuations there. So when you see these businesses that you've got a great book on, because we've been watching many of these companies for a decade, and you want to be participated in those stocks, and they come on sale, it's a great time to buy. But you got to be careful that you're buying a value, because price is what you're purchasing, but value is what you get. You need to make sure that the company you're buying, even if it comes off 10%, it could be 40% overvalued. So it still could have to come down 40% to be good value. But if you can run those numbers, know that business, know the management team, know the balance sheet, and it comes on sale, it is definitely exciting. And you get to enter into these great companies at what can be a discount to their intrinsic value over the long term.
What you're saying, though, is so key, is that people get a little too enamored on the price point. And again, it's value. It's sort of like saying, hey, look at this fabulous Lamborghini or something. But is it worth the $400,000? But somebody's selling it because they got a distress sale happening and it's $25,000. I'm jumping on it, if you know what I mean. So I just think your point's so well taken.
A great example of that this week, you look at Twitter. Twitter is a great company, one of the better social media businesses out there. But heading into this week's earnings, it was trading at 95 times expected earnings next year. Well, they actually hit good numbers, but there was a tiny little wart in there, and all of the FANG stocks outside of Google or Alphabet had a little wart in the numbers. And, the stock was down 20% on Friday alone because it was absolutely priced to perfection, which even in a great business is unrealistic over the long term. If you have, out of those, we saw Alphabet going into this week priced at about 26 times next year's earnings. So they hit it out of the park, but they weren't absolutely priced to perfection. So they were able to actually have gains in the market this week, whereas all of the other FANG stocks were down because there is no margin for error in some of those businesses when you are priced to those levels. So you can't just fall in love with the business. You've got to see what price you're paying.
Well, I just want to reemphasize what you've just said there, because we hear the term price perfection, and just to make sure everybody's up to date with us on that just means we're saying, hey, if everything goes right, if we have a great economy, and then we have, we were able to get the technology working to reduce our costs, and China has a robust growth profile, and the U.S. does, then this will happen. And as Brian says, some of these stocks got priced right through to, if everything goes right, then it is worth this. But of course, not everything goes right in an environment like this. So that's what he's saying, and it's another important aspect. Let me just get a quick moment here, and I'll ask you for a couple of stocks. But first of all, people should know that we do the World Outlook Conference, and Ryan and I and Aaron Dunn have been talking about the small cap portfolio for over a decade. Man, do I ever put pressure on them. Just so everybody knows. And I'll tell you, do we ever, and Ryan says, well, we're going to recommend this and all this, and they all sound great to me, and they follow a methodology I understand, and they continue to deliver. And I just want to say that again, people should not be confused. The overall market has been so dominated by the high techs, by the ones you've just talked about. Without them, you don't have any kind of performance. Like, for example, I'm looking at the TSE broad return, and it's minus 11% right now for the year. Minus 11%. And I'm looking at your portfolio, Ryan, and I'm the small cap portfolio up 25% right there. Every single stock you recommended went up.
Yeah, I mean, that's key. We're very pleased with those returns. Like you said, the market is bifurcated. You have the FANG stocks dragging up the entire market, but you look at the TSX index itself, which doesn't include those. It's down 11% since we talked about that portfolio at the Outlook. The four stocks there did tremendously well, 25% up. You had Viamed in there, which we've recommended on this show a number of times. It was up 57%. And we talked about Enghouse briefly, up about 25%. I think the common theme that we looked at in all these businesses when we started the year, because we thought market valuations were broadly higher at that point, all of them had cash-rich balance sheets, great balance sheets, producing cash flow. And when I say cash-rich, they're net of their debt, which most of them had no debt, but one of them had a little bit of debt. They had a great cash position there. So during a pandemic, they're able to survive, or any downturn in the market. They're able to survive, and they thrive coming out of it. Two of them, Enghouse and Viamed, thrived during that pandemic because of their specific businesses. One is in telehealth, part of its business. The other one Viamed provides respirators in a time where You saw vents, and they also provide vents for the hospitals. So you're talking about a business that was in high demand at that time and continues to be going forward in the home healthcare segment. So two businesses that really did well during the pandemic, and coming out of it, we think they're well positioned going forward. So we'd still recommend all of those stocks now. I think of the four, we talked about Viomed, Sylogist, Enghouse, and Dynacor. The valuations on Dynacor, you talked about gold stocks earlier. It is one way to play the gold segment. Dynacor is a miller. They mill gold in Peru, and they are the highest yielding gold stock out there. They pay a dividend of about 3.4%. Great cash in the bank. Their mill has started up again. It's hit capacity once again in Peru. We think that going into the second half of this year and into next year, it trades at about 4 times cash flow. So that's a low valuation. If gold stays in the same range, they should make a good buck and power that stock forward over the mid to longer term.
Well, time's short. We only got a couple minutes left. Can you give me something that's not on that list? Maybe you'll be talking about it at your webinars, but give me another stock to have a quick look at.
Yeah, in the home healthcare segment, we like Protec Home Healthcare, symbol PTQ on the TSX Venture. It trades at about $1.65. It's in-home monitoring and disease management, end-to-end respiratory solutions, somewhat in the same business as Viomed, but we trades at a discount to that company now with the great returns that we've seen in Viomed. Growth in revenues in the last quarter, 28%. Adjusted EBITDA was up 47%. They just upgraded their guidance in the past week with a solid acquisition that they completed. We value them based on an EV to EBITDA model. Their peers traded about 12 times that model. We're just multiplying them by 8.5. That gets us a target right now from $1.63 in that range to up to about $2.20. So it's around 40% higher than where it is right now. We like to buy good businesses with growth profiles at a discount to the market, and that's what we see with Protec.
Well, I love again that when we talked about this coming into the World Outlook Conference, we had clearly said on Money Talks, we thought there was a major change happening in the market, panic coming at the end of February, and you said, well, that's why we look at companies that have strong cash flow, because no matter what happens, you've got an operating business. And obviously that's paid off really in spades for you. So let's just go back over very quickly, Ryan. You're going to do a webinar, November 10th and November 17th. You can get details at mikesmoneytalks.ca. You got to sign up early, though. And you'll talk about, again, what's in our controls. How do you build a portfolio? Don't be the guy that says, oh, I wish I had everything in that one stock, or, that kind of stuff. You're always talking about that, but I think it's a great opportunity. And you will talk some more gold, I think, and you're talking about the FANG stocks and renewable energy, too.
Yeah, and we're really excited. We're doing a case study approach to detail practical tips on how to build or repair any portfolio. Whether you're retired, middle stage, early stage, all of those stages, we will give you basic recommendations on how to put that simple 15 to 25 stock portfolio together. Take control of your portfolio, stop paying those high fees, and earn more money over the long term. And we think it's a great way to do it. That sweet spot is 15 to 25 stocks. You're always going to hear a lot of noise in the markets, but those two things you can control is how you build that portfolio and what you put in it. We'll help you with both of those things, give you 5 to 6 stocks to buy right now.
So go to mikesmoneytalks.ca, sign up, get more details. Ryan, happy Halloween. I know you'll be busy tonight. Keystocks.com. Thanks, Ryan.
Thank you. Have a great day.